Hello there, Maverick Traders. This is Rob Reinhold. It is the Trading Room, and let's get into it. In this session, we're going to talk about the news of the week. Big move up this week, biggest move of the entire year. We're going to look and see how that changed not only the market score, but all the sector scores. And then I've got 5 trade setups for you. Let's jump into it.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so this last week, we had the markets continue this rally off the bottom. 2 weeks ago, we had this amazing VIX spike. And here's a chart of just what it looked like. If you take a look at this spike, we spiked up to about 65. This was the highest spike since COVID and actually got within just a few points of the spike of COVID. I read a few articles that talked about how this was really not a true panic like we've seen in the past, that it's most likely due to illiquid options in the SPX being priced into the VIX. Look, there's lots of things we could talk about, but look, this is what happened. We got a VIX spike, and whenever you get a VIX spike, you get these capitulation moves where people panic, people throw in the towel, and you typically get a pretty good bounce, and you can see we have just completely gone back to normal. We were at 15 on the VIX 3 weeks ago, and guess what? We're 15 on the VIX today. So the markets have calmed down. And everything that just happened that maybe is still in your memory, the market has completely forgotten about it. When we take a look at the bond market is just hanging out right between 3.7% and 4% on the 10-year U.S. government bond. We got a little bit of a tick up off of that bottom. And if we take a look at the FedWatch tool, you can go to the CME's website, pull up this FedWatch tool. Last week, we ended the week at a 53% chance of a 50 basis point cut. This week, we ended up at 25% chance. So the market has really backed off that 50 basis points. It's because we got some really, really good economic news. And one of the things I pointed out in my video yesterday was I just want you to take a look at this chart. There's virtually no pullbacks for the entire week. The reason that happens is that people put in institutional orders. Institutions, when they put in orders to buy 5 million shares of Microsoft, 10 million shares of Verizon, they don't go out and buy those all in one day at the market. They sit there and they put orders out on the bid for weeks in order to scoop them up. Whenever selling comes into the market, there's a bunch of buyers on the bid. And I always say that the bid is a mile thick. If the bid's a mile thick, we just don't get pullbacks because everyone is there waiting for people to sell so they can buy it cheaper off the bid. That's really what we saw last week. And you know what? We ended the week in the same place. We ended the week at a high. So let's quickly go through the economic news. On Tuesday, we got the PPI way lower than expected. And when I saw this number, I actually thought that the market might react poorly because this is too weak. If we start to get too weak of economic numbers, remember the panic started when we got a weak employment report and a weak jobless claims report. And all of a sudden the market freaked out. But on Wednesday, this CPI came in and it was a perfect number. Perfect, absolutely perfect. Not too hot, not too cold, perfect. I actually think if this number came out like the PPI did, I actually think we would have had some trouble. But this was a number the market loved. So again, these numbers are good. And then check out this retail sales report. I mean, this is just a home run. The consumer is still out there spending. The economy's still great. Jobless claims continue to drop. Everything is back to a bullish market. The sentiment in the market is back to being bullish. The charts of the market are back to being bullish. Look, I know that it's very difficult sometimes when you get these freakouts and the market crashes. It's very difficult to get back on the bullish side. Now, I am a recovered perma-bear. What that means is in my early career, I was always negative. The sky was always falling. The markets, if they went up a lot, were always too high. They were going to come down, and the next disaster was around the corner. So I doubted anything good that happened in the stock market. It took me years to unwind that, and I know that I have some perma bears. And look, and I used to listen to Kyle Basses and all the people who said bearish stuff on CNBC. I loved them because they were speaking to me about that pessimism. Well, guess what? It doesn't help you as a trader. We are clearly bullish here. I mean, just take a look at the returns this week. This was the best week of the entire year. The Q's up 5.5%. Oil was down a bit, but gold, we are hitting all-time highs in gold. So the market is trying to tell you, hey, I know you might feel bearish. You might feel like things aren't that good. You might feel like that freak out we had 2 weeks ago isn't done. Those are just feelings, and those are your biases. When we take a look at numbers and we take a look at charts, you can't argue with the facts that we are back above the 50-day moving average. We are back above the 20-day moving average, and I just want to show you these candles. Gap up. We gapped up, and people bought all day long, and they were still buying when they closed the market. The market gaps up. We get a little pullback. They buy, a gap up, close at the high, a gap down, they buy it immediately, close at the high. This is telling you that there are buyers out there. We have not yet cleared out of this resistance. But look, take a look at the last 3 or 4 days. It's like this resistance doesn't even exist. We could still maybe back off a little bit this week. I actually do think that this week is a very light week news-wise. I think we probably creep a little higher, but we might back off a little bit. But there's nothing in this chart that is telling anyone to be overly bearish. It's not telling anyone to be overly bullish either, but it's definitely not saying to be bearish. If we take a look at NASDAQ, we're same place. We are creeping up out of that resistance areas, looking to go a little bit higher. Take a look at the heat map for the week. It was across the board buying. Everything went up. Every single sector was up for the week. So what does that mean for this week? Look, like I said, I know you may not feel bullish. I know that 2 weeks ago we were, all freaking out on CNBC and looking at this VIX spike. You got to put that behind you. That was 2 weeks ago. Going forward, what does it look like? Economic growth looks solid. Retail sales look great. Inflation's under control. We're going to get a half or a quarter point rate cut in September. Markets are feeling very, very positive here. If there is a negative, we haven't clearly broken out of those resistance areas. It might take a week or so. We'll see. I don't think it will, but it could always just hang out here for a little bit. There's no question that all the signs we look at in the market are telling us it's likely going higher. This weekend, starting on Friday, will be the Jackson Hole Symposium. They've been doing this symposium for decades, but no one even cared about it until about 12 years ago when Ben Bernanke announced new economic policy at the Jackson Hole Symposium. The market freaked out, and then he did it again the next year, where he's making major changes to monetary policy at the symposium. So all of a sudden now people are watching this to see if there is possible changes. I don't think there's going to be anything this year. It's very clear where the Fed is. There's no one's wondering where the Fed is. It is just crystal clear. So I don't think this is going to be a concern at all this week. And you can see, other than that Jackson Hole Symposium, there is no news of really any importance this week. I'm looking at where we are, where we closed the week last week, and I'm at between a +1 and a +2. We are above that 50-day moving average, but again, the 50-day moving average is such a slow moving average. 2 candles above it, I'm not quite ready just to jump and say, hey, we're at a +2, but we're definitely probably stronger than a +1. I've got a +1 on the week. I think we've gone a very long way in a very short amount of time. Usually we see bases or small pullbacks when we get that big of a move, but this is a very, very quiet week. It's an August week. I think we're just going to get a slow creep higher. That's what I think we're looking at for this week. Let's go check in on the sectors and see the changes there. If we take a look at performance, as I said, everything was up. Everything was up. But I do want to point out the defensive sectors. So we've had 3 sectors at a +3. Utilities, real estate, and healthcare have been +3s for weeks. I want to just point out that they underperformed. Now, it's not a surprise that they are going to underperform. They are defensive sectors. They're defensive sectors that typically go up when the market panics. They're holding their gains, but they're not adding on to their gains. Except for healthcare. Check out healthcare. And we're going to look at a chart on healthcare. Healthcare looks great. So healthcare to me is still a +3. These other 2, they're +3s, but they're fading a little bit. We'll take a look at all these charts in a second. What had the biggest jumps? Well, the things that were the worst. Things that got hit the worst had the biggest jump, but that doesn't mean they're the best place to be. I'm really looking at the places that held in well on the way down and participated on the way up. It's right here. Healthcare, industrials, financials. These are my 3 favorite sectors. Let's take a look at some of these charts here. Here is utilities. Last week a +3. It's a +3. Look at these candles though. All green candles. All green. Means that they gapped up or they gapped down. But regardless of where they gapped, there was more buyers than sellers that day. Not a lot, but more buyers than sellers. Here is communication services. Last week was a +1. We're bumping it up to a +2. It's not crazy. It's not crazy bullish. It's not a wild run like we've seen over the past couple of years, but it's creeping up there. It's showing some, decent strength. Here is the real estate sector, and you can see we're just basing. I expect that if this market goes higher, I think that real estate and utilities will likely go sideways to slightly lower. That's my outlook for these. But when you take a look at it, just technicals, it's a +3. If you're in real estate, don't be scared of your positions. Don't be scared at all of your positions. They're going to probably hold in there. Now, if you need them to run for you, probably not going to happen. Here is healthcare, and take a look at how great healthcare is looking. Last week it was a +2. This week we have cleared out of this range. And this is what I'm talking about sectors that held in really well. Look at this sector. We barely tickled under the 50-day moving average. Compared to the rest of the charts, this is fantastic. It held up on the way down, and now we're higher than we were back in July. This sector looks great. Healthcare, to me, is one of the best sectors out there. If we take a look at industrials, industrials has had a nice bounce back, and take a look where it is. It is back knocking on the door of where it was before the market tanked. But it did get hit. Way worse than the healthcare sector got hit, but it's recovered. It's recovered nicely. Now remember, when we take a look at the S&P, we have fallen and we have recovered about 66%, about two-thirds of it. This has fallen and we have recovered about 95% of it. It's telling you there's outperformance here, +2 on industrials. Take a look also at financials. Look at how close financials are to its high of July. It's right there. It's recovered 90% of it. So that's a +2. We come over here to consumer, discretionary, and it had a giant bounce last week. But take a look where it is. When we take a look at these charts, you can see that these were the ones that really underperformed, and they started underperforming well before the rest of the market. It's had a nice bounce back. That's great for it. It's a 0. Same thing with tech. Tech is the same chart basically. It's at a 0. It very well could be that consumer and tech will be the best performing sectors if the market continues to rally. And guess what? That could happen. I'm not going to be focused there. I want to be focused on the safer trades that held in nicely, and that is going to be what we just looked at. Financials, healthcare, and industrials. Materials, +1. So we've recovered about half of what we have. It's not great. It's not terrible. Just a +1. We come over here to energy, and it's, again, recovered half. It's right at the moving averages. It's at a 0. If we take a look at the movement here, healthcare got upgraded. So our 3 best sectors are healthcare, real estate, utilities, defensive sectors. However, I need you to understand that real estate and utilities are probably not going to go much higher. They likely hold in, but they probably don't go higher. So I don't think these are great places to go look for new bulls. If you have bulls in these sectors, guess what? They're probably going to do great. They're probably already doing great. I don't think it's time to add new bulls to that sector. We got moves up in industrials, financials, and comm services. This is where you want to focus. Healthcare, industrials, financials, and some comm services. Materials jumps up to a +1. Everything else goes to a 0. As I said earlier, these 2 sectors could be the best sectors over the next couple of weeks. I don't care if I miss them. Because guess what? Technically speaking, they're still underperforming. I'm going to be focused over here on these sectors.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
Let's take a look at our trade slots that rolled off this last week. We had 5 trades roll off. We had a bullish trade in utilities, NEE. It was basically a break even. Our bullish trade in real estate was a max gain. We had our +2 trade in Otis Elevator was a max loss. And then in financials, we had a sideways trade in TD that was a small gain. And our trade in healthcare hit the bullseye. For only this second time in my entire trading career of 27 years, I did a butterfly where the stock landed exactly at the midpoint. So take a look at this chart on Abbott Labs. It was a 107, 111, 115 butterfly, and it landed right on the middle. Here's the worst part about this. I shouldn't say it's the worst part because it was still a great trade and a great gain, but typically on a butterfly, you only have to close out one of the short options. So if this stock ended up at 110, I would just have to close out any of the trades or any of the options that have value, which would just have been the long leg, and that would be it. If it closed up at, 112, I would have just closed one of the middle short legs and let the rest either expire or get same day substituted. At the close, when it's that close, you have to close both. You have to close them both, and you actually end up making a little bit less than if it was like at 110 and 95 cents. If it was at 110, 95 cents, I would feel okay just closing one. But right there, I had to close it both. But look, it was a great trade. So we have lots of slots that have opened up. Let's go take a look and see how we're going to fill those. So we've got a +2 market. Well, I'm going to give this a +1 score. I gave it 1.5. Look, I have no problem slow playing it. I have no problem being a little bit late to any little rallies here. I'm still going to be leaning here on the bullish side. So here's our allocation. At a +1, the allocation is 2 +2s, 5 +1s, 4 zeros, 3, and 1. Those are the slots I have available and open to fill. As you can see here, the black ones of our trades we already have on. So we had a lot of bullish trades roll off this week. We now only have bearish trades. The best thing that could happen this week would be a little pullback. A little pullback, we would love to see that. Love to see that. A little bit pullback. I don't think we'll get it. So look, we'll just add on some bulls here. We don't have to get crazy. Once we get to a +2 and a +3, then we can start to increase our bullish delta. But we wait for the technicals to tell us what to do on these. So let's go ahead and look at real estate, sideways, healthcare, industrials. Financials is my favorite, so I'm going to do my +2 there. And then we'll do a +1 in consumer to bring that sector more towards that 0. All right, let's jump into the first one, real estate. All right, this is Annaly Capital Management, looking for a sideways trade. As I said, I think real estate holds in, but I don't think real estate and real estate and utilities go much higher. Look at this stock. It is pinned. It is pinned. It is just hanging out. 20 is the natural point here. So we're looking at just a sideways trade 2 weeks out. This one does have monthlies. So we're going to go 19, 20, 21. So this is going to be our range. Our profit area is probably going to be about right here. As you can see here, 2 weeks, basically it can't break out to the upside and can't break down to the downside. And we're going to have a nice little profit here. Looking for some singles here in real estate. Moving on to healthcare. Look, healthcare, I debated, do I want to do a +2 in healthcare? And I thought, you know what? I'm just going to go +1. I just go with the +1 here. You could do a +2 if you wanted. This is just a really great looking sector. This here is Cardinal Health. Cardinal Health had a good earnings report. I don't read earnings reports anymore. I used to read earnings reports and listen to conference calls. I always say now, the news isn't important. The reaction to the news is important. And you can see in the chart, the reaction of the news, people like it. I don't need to know what the earnings report said. This thing's got a ton of momentum at the moment, but I'm not really playing it to run up to 120. I'm looking to play it as a +1. So I just need this thing to hold. I just need this thing to hang out and close above 110 in the next 2 weeks. If I do that, it's going to be a nice gain. It's going to cost me $3. So I got $2 of upside, $3 of cost. Much greater statistical probability than 50-50 on this. These are the trades, again, they're singles. We're just looking for some singles here on the bull side. Industrials, also looking for a +1 trade. I'm not looking for something that's taking off running. That's what I want to find my +2s and my +3s. This is GE Aerospace. I wanted to call it General Electric, but I realized I can no longer call it General Electric. It's still General Electric, but it's just their aerospace business. And you can see it's just hanging out here. If you go back and pull out a longer dated chart, this is simply high basing, consolidating from a really massive run it's had earlier in the year. I'm looking at this saying, hey, I feel very, very comfortable doing a 165, 170, meaning it just has to just hang out up here. If it hangs out up here, goes a little higher, I'm going to have a nice single here as well. Not looking for any home runs in these sectors. If you do want to get a little bit more bullish, there we go, a 165, 175 bull call spread. Give it one more week for some time, but I'm going to play it as a +1. Financials was the sector I decided I want a +2. I want a +2. I want something a little bit more aggressive on the upside, so I came across MasterCard. I like this one. We've got a bull flag. If you go back on this chart, there is a huge run up to this point, all the way from the low 300s, all the way up to $490. So what happens is these take these little flags down. So you got this very long flagpole and you get these really shallow flags down. Once it breaks out above those, that's the buy point. You can see we got a gap from earnings. We pulled back to that level, bounced off of it. To me, I think we're headed back up towards all-time highs here. I don't need to play it that aggressively. I'm not a +3, but I'm going to be a +2 here. So 465, 480. 465, 480, that's what I'm looking for it to move outside of this range of 480. That's going to give me my max gain here on a +2 trade. And then last, we wanted to add a +1 in consumer to bring that consumer sector back a little bit closer to 0. We have a -1 trade in it. If we put on a +1 trade, then all of a sudden the sector exposure is going to be more of a 0. And here we have McDonald's. And again, this is just a beautiful chart. This stock didn't get hit in the big panic. Now, it underperformed a little bit before, but they had an earnings report. People loved the earnings report. It ran up. It pulled back, a very orderly pullback. And now take a look at the move here. Everything looks good. I'm looking to do just a +1 trade. As you can see, I'm not yet ready to go to +2, +3s. I do have to understand that we are moving into September 1st to October 15th, which is the worst 6 weeks of stock market returns historically. Every year we've come to this point, and I've made big warnings in mid-August saying, hey, everybody, we need to be aware of what's about to happen. And for the last 3 years, it's been perfect because the markets have had its worst 6 weeks of the whole year in the last 3 years. Will that happen again this year? I don't know. I actually don't think it will. The fact that we just had this little freak out, I actually think it got that anxiety out of people's system. But it's something I have to be aware of, even though I don't personally think this time it's going to be bad. That's just my opinion. I have no idea. So I don't want to get too far out over my skis. I'm very happy to be just hanging out in a +1, +2. Even if the market's a +3, I'm very happy to play it a little safe here during this time period. So we've got McDonald's pulling back. I think, again, 275, 280. This is a +1 trade. Again, I'm not asking it to go very far. It just has to drift up and hold these recent gains, and that's going to be a max gain for this trade. All right, if you guys have any trades you want to share with the rest of the Maverick group, log on to the website, go to the forum, share some trades. The market's quickly back to bullish. I know that some of you perma bears are going to have a hard time getting yourself there. Look, that's fine. You don't have to feel good about it. We have a saying at Maverick, sometimes you got to plug your nose and buy. When it's bullish and you don't feel like being bullish, the charts trump your opinion. Your opinion is made up of politics and what you heard on the news and what's happening in your own personal life. It's not the reality of the world. The chart is the reality of the world. Your opinion is completely local to you. If you can't get yourself to feel bullish, that's fine. You don't need to be bullish. You just have to be bullish in your trading. You can hate it. You can regret that you're bullish in your trading, but you'll be okay if you make some money here. All right, we do have a big run, so okay, pullbacks and bases are literally just opportunities to get more bullish at this point. And we did talk about September 1st to October 15th. We can't ignore it. It's here. Make sure that you are not overextended going into this because it could happen again, just like it's had the last couple of years. That is the trading room. Great job again this month. This month was a difficult month, but by the end of the month, when we're closing out our books, it's actually looking like a pretty solid month. So since we just closed our books with monthly options expiration, we'll do the accounting on Monday, we do payouts on Tuesday, and we do level advancements on Wednesday. Everyone have a great weekend. Goodbye.